just to give an overview of what I'm going to be talking about, I'll spend a bit of time going over the outlook for China as we see it, given its importance, obviously in its own right, but also as well as its role in terms of the size of the economy and market in the region. And I'll also touch on the other sort of key uncertainty which has hung over Asian equities over the last 12, 18 months or so, which is the global goods cycle and what the outlook is for exported manufacturing products, particularly in IT, the information technology and hardware sector, where we have quite a lot of exposure to in this trust. And then finally, I'll also just touch on valuations, where those sit in the region and the opportunities that they may present. So let's start on China, and this has obviously been quite an important driver of the markets in Asia this year. And I think the sort of chart we've got here on the right, you can see the sort of number of negative articles being written about China at the moment are pretty overwhelming. They're record highs. The sentiment on China has turned extremely negative this year, and I think the cover of The Economist we've put on there just as a sort of tongue-in-cheek summation of that sort of consensus view shows that there really has been a deterioration in the view of investors towards China over the year. I mean, if you remember, almost exactly a year ago from when we were speaking, the Chinese government moved very abruptly to end its zero COVID policy, pretty much overnight, really, with very little preparation and much faster than people expected it to do. And that policy had been doing really enormous damage to the economy, and 2022 was a particularly tough year for China's economy. So at the start of this year, there was a great deal of optimism about the prospects for economic growth in China with that recovery coming through. But that's really not been something that we've seen this year. And I'll touch on the reasons for that in a second. But just to point out, there has been a bounce back in activity. Of course, there has after such a difficult year last year, but that really has been more focused on some of those areas you'd expect. So hospitality, travel, hotels and the like, restaurants, eating out, things that were really restricted during the zero COVID policy. But the broader economic growth hasn't really been all that strong. And I think part of the reason for that is on these charts here, and particularly the chart on the left there, which is the consumer confidence in China, which, as you can see, completely nosedived during the zero COVID policy. The lockdowns that China imposed on the population were extremely strict, and there was very little sort of wiggle room around them. So people really lost a lot of confidence in terms of their willingness to spend. And what's interesting is with the removal of zero COVID policy, you can see there in sort of December 22, so about a year ago, you did see a recovery in consumer confidence for a while. It did bounce back off its lows, but really throughout this year it's gone crashing right back down to the lows again and stayed there. So the issue in China has not been a lack of savings or lack of household ability to spend. You can see the chart on the right there. Actually, the savings rate in China remains as high as it's ever been. Yes, there wasn't an enormous increase in excess savings as we saw in the West, but still the savings rate is in absolute terms extremely high. There is no shortage of ability of the consumers to spend, but there is a lack of confidence in things like income growth in the property market, very importantly, which has held back those sort of animal spirits. And we're seeing that both from a consumer point of view and in terms of broader private sector investment by businesses as well. So, with the sort of sluggish income growth, lack of fiscal stimulus, the difficult property market, all of those things have been contributing to this very low consumer confidence. So that's the cyclical picture. But I think it's also worth touching on why the trust is so underweight China. We have been underweight China for quite a significant period of time. And that's not just around these sort of cyclical short-term economic points. There really is, some of the more challenging structural long-term issues that China faces, in our view, which haven't really started to be tackled yet by policymakers. The chief amongst those, as investors, what we care about is that the return that investments can make in China. And I think what we've seen over the last few years, actually last decade or so, is a real deterioration in those returns that capital can make in China. So if you see the chart on the left there, what we've tried to do there is put China as it currently is in the context of a number of other Asian economies at similar-ish levels of development at the time. So Japan in 1970, Taiwan 88, Korea 1990, and looking at their GDP per capita at those points of development, which you can see are roughly in the same sort of ballpark as China is now, all measured in real terms, and then look at the capital stock in that economy per capita as well. And what really stands out is the amount of capital in China is really quite significantly higher than any of its peer countries were at similar or even more advanced stages of development. So that tells you there really isn't a shortage of capital stock in China. That's not the issue. There's plenty of infrastructure. There's been lots of building of property, infrastructure, manufacturing investment. The capital stock has been high, but what's been the issue is the chart in the middle there, which is the returns that you're making. This is an incremental capital output ratio, so it's the inverse of returns. It's a measure of how much extra investment you need to put into the economy to get one extra unit of GDP out. So it's telling you that over the last 20 years or so, that's been relentlessly going up. The amount of investment you've had to put in to get the same amount of growth out has been going up. So the returns on investment, which is the inverse of that graph, have been coming down. And maybe in that context, the chart on the right there isn't so surprising why Chinese stock markets have really struggled to perform over the last 12 years or so. It is that point about return on capital, which is what ultimately drives returns to shareholders like us. Now, from our perspective, that economic model, there hasn't been any sign of that shifting materially over the last few years. Even post-COVID, a lot of the government policies have not tended to really push back against that growth model. So we don't see a prospect that there's going to be a huge turnaround in the return prospects for that market. So we remain pretty underweight China, as we'll see in a bit. One offset to that is Hong Kong, which is a separate market. Of course, over time, Hong Kong has become ever more part of the Chinese economy and more intertwined with the Chinese financial system. But one reason we do like Hong Kong is, firstly, the companies there tend to be slightly better governed. There are better regulations and protections for minority shareholders. Capital allocation tends to be a little bit better than Chinese companies in the mainland. But another reason is more cyclically, Hong Kong does look like it has a stronger recovery coming from the resumption of arrivals from mainland China. So as you can see in this chart, for the last 3 years or so during COVID, the amount of visitation from into Hong Kong, which is mainly from the mainland Chinese visitors, really fell to zero from levels of many millions in the years before that. And that has just started to recover this year, of course, with the removal of zero COVID policies. So that should be a really strong tailwind for Hong Kong, and particularly for some of the companies in Hong Kong, which have historically relied on mainland Chinese visitors for sales. So whether that's in consumption or whether it's financial services serving Chinese visitors to Hong Kong with their financial products and insurance and so forth. So that's one reason we do like Hong Kong. Another area we like in Asia is the IT space. And I should say in Asia, IT largely means IT hardware. There are some IT services companies as well, particularly in India. But when we talk about IT, it's largely around hardware, and in particular semiconductors. And this chart just shows the sort of long-term reasons why Asia is so well placed from a IT hardware and semiconductor point of view. I think we're all pretty much familiar with the drivers of increasing semiconductor demand in the world. There's clearly trends around digitization, cloud-based applications, connectivity with 5G, and now, of course, this year's hot topic, AI, which still remains to be seen exactly how big of a driver that will be. But there's no question that most companies around the world are looking at AI and how they can best exploit that for their businesses going forward, and the disruptions that will bring to business models across many different industries. Now, what all of those have in common is that they require much higher content of semiconductors, silicon content, chips being manufactured. And while maybe some of the names in Asia aren't household names in the same vein as a Microsoft, Google, Facebook, or indeed Nvidia, the actual chip manufacturing has become extremely concentrated in Asia over time. I think investors are becoming increasingly aware of just how critical Asia is in the supply chain for semiconductors, particularly Taiwan and Korea. You can see the pie chart on the left here. Korea and Taiwan make up, over 50% of worldwide semiconductor manufacturing capacity. And when you look at the most advanced semiconductors, those you need for AI, for 5G, for some of the more advanced logic nodes, those are very much concentrated in Taiwan for logic, and South Korea for memory. And you can see the chart on the right there just shows the number of players globally who can manufacture chips. As you go along the x-axis, those become more and more advanced chips, the smaller geometries. And you can see really by the time you get to the most advanced chips, there's only really a handful of companies globally which can manufacture chips. Intel, there's a question mark over them. They've really been falling behind the two Asian names, TSMC and Samsung, over time, over the last couple of generations. So really, if you're a manufacturer, if you're an Nvidia and you want your advanced AI chips manufactured, there really isn't a lot of choice as to who's going to do that manufacturing for you. And as you can imagine, that puts these companies, particularly at the cutting edge, in a really strong bargaining position and giving them lots of pricing power when it comes to manufacturing these chips. So IT is an area we do like. I touched on a little bit earlier about the cyclical side of IT. Clearly, the long-term story is very strong. But what about nearer term? It's obviously been a tough sort of 12 to 18 months for many exporters in Asia, and that's not just in IT. That's been across many different sectors. One reason for greater optimism at the moment is that compared to a year ago, that goods cycle now looks to be in a much healthier position from what we can see from statistics such as these, the export volume starting to grow, but as well looking at survey data, ISM manufacturing surveys, new orders versus inventories, and looking at how those historically have correlated with exports from Asia. Those all suggest that actually demand for Asian manufactured goods is improving. And that follows, as I say, around 18 months or so of slowing demand, as we're all very familiar, too familiar, is high inflation, high interest rates has really put a damper on consumer incomes in the West, and that's put pressure on demand for manufactured goods coming out of Asia to serve Western consumers over the last 12, 18 months. That does now look to be moderating. Some of the inventories that had piled up in sectors ranging from power tools to bicycles to semiconductors and consumer electronics, a lot of those inventories now look at much healthier levels. And importantly, what we've seen is much more supply discipline as well. Yes, demand is recovering, albeit slowly, but what's been more in the control of Asian manufacturers is cutting capex, cutting supply expansions, which means that actually now the demand supply balance looks much healthier going into next year than it has done for a while. So that should hopefully put them in a better position to start to grow sales and earnings going into next year. So we're looking a bit more optimistic on that front. And another reason for a bit of optimism is where valuations now sit relative to history. So just looking at simple measures, price to book in aggregate for the region and the historic price to earnings, those are not quite at the lows that they reached during the COVID gloom, but they're not far off those bottoms and still look very reasonable versus their long-term averages. And whether that's over the last 10 years or even longer term, those look pretty undemanding valuations to us in aggregate. And I think the context of that needs to be borne in mind. Part of the reason for these moderate valuations has been the backdrop of rising interest rates globally and the stronger US dollar, which historically have been pretty difficult times for Asian markets to perform well when you've got both high interest rates and a strong US dollar. As we're hopefully entering a period of disinflation and lower US interest rates, lower dollar, that could act as a support for Asian equity markets, as it has done in the past. Historically, that's been a period where Asian markets have done better when you've got those falling rates and weaker dollar. So we're not macroeconomists, we're not forecasting that, but clearly the moves we've seen more recently are a bit more promising from that perspective. And just another point on valuations, I think looking at the aggregate numbers only tells you a small part of the story. What's more interesting to us as active managers, as stock pickers, is the variation that we are seeing in valuation across the region. It's a pretty heterogeneous region, Asia. There are very, very different drivers in the different markets across Asia, and that's reflected in the different valuations we can see now. There's a wide range. Some markets looking really relatively cheap now compared to their historic ranges. The sort of light colored diamond is where current valuations are sitting in terms of the forward price to earnings, and then the blue band is the one standard deviation band of those valuations going back to 2010. So you can sort of see where they sit relative to their history, and you can see markets like Hong Kong, as I mentioned, Philippines, Singapore, looking really relatively cheap relative to their history, and increasingly that's true of China as well. Notwithstanding everything I said about the structural challenges, at least those challenges are now being reflected in valuations in the market. So increasingly there are some stock opportunities that we're finding there. On the flip side, you've got markets like Thailand, but particularly India, we would highlight as looking much more expensive relative to their history. India is benefiting from all sorts of trends, whether it's manufacturing supply chain shifting away from China and increasingly looking at India as a secondary sort of source of supply, but also the domestic liquidity situation has been pretty strong in India as well. So that's been contributing to higher valuations. And I think one other point to make here is Taiwan and Korea, which are the sort of hubs for technology, as I mentioned. Those do look fairly fully valued, but it's important to remember that the earnings there are still quite cyclically depressed. As I was talking about, the inventory cycle has been quite brutal in that space over the last year or so. So earnings still have some recovery to go there. I won't touch too much on performance. The 1 year number is slightly negative. It's been a tough year given China's outperformance and given our underweight to China. But longer term, the track record is pretty positive, as you can see there, in both absolute and relative terms. And clearly, the longer term picture is here. Please obviously take time to study that at your leisure, and of course read the very important disclaimers and risk warnings. But I'll just end on our positioning. The standout positioning from a country point of view, as I've mentioned a few times, is our underweight to China. You can see they're very substantially underweight to China, offset to some extent by the Hong Kong overweight, as I said. But we're also very overweight Singapore, one of those cheaper markets, as I mentioned, that's got a lot of high quality companies in Singapore at pretty attractive valuations. We also aren't just restricted to the benchmark. We do have off-index holdings in Australia and Vietnam. And in Australia, that tends to be the blue chip commodity names, which are very much tied into Asian growth. And just a point on gearing, the trust is modestly net geared, and that's obviously in the context of where valuations sit, as I mentioned. From a sector perspective, I've mentioned the overweight IT and the reasons for that, but we're also overweight financials as a significant overweight, and underweight some of the sectors traditionally viewed as a bit more defensive, so things like consumer staples and utilities, which to our mind look pretty expensive for the growth outlook in those sectors. So we're underweight there. Financials, just one quick point on that. It's a very diverse sector. It's not just banks. There's insurance, there's stock exchanges, and of course what you've got to remember is that the sort of dynamics vary quite significantly by country. So the drivers of returns for an Indian bank or an Indonesian bank are really quite different to those banks in Singapore, which is a much more mature financial market. So I think that's my time basically up. I'll conclude my presentation.